Are you a first-time home buyer that's excited to embark on the journey of purchasing your first home? Are you eager to make the most out of that hard-earned money while making sure you're getting the best deal possible? Well, look no further. Welcome to our exclusive video where we're going to unveil the strategies on how to improve or increase your buying power for first-time home buyers like you in today's market. You know, being a first-time home buyer, you're going to have many people that are going to give you advice along the way. And having advice from people who have already been through that process is always good information to have. Our goal is to make sure that you have the right information from a lender's perspective on the best strategies to maximize your buying power. We have been seeing more and more first-time home buyers getting into the market that are really wanting to see what their options are and are getting a little discouraged because they speak to some other lenders or they kind of do some of their own analysis and they just don't feel like they're qualifying or they're being advised that they don't qualify for the purchase prices that they're really hoping to get into. So when they refer to us, we're going back and the first area that we really start looking at them with is their debt structure. A lender is going to look at something called a debt to income ratio as one of the first legs of their pre-approval. And when you look at a debt to income ratio, it's not a total amount of a person's debt, it's a total amount of their minimum monthly payments for that debt. So we have a few strategies that we try to follow through on that. The first one is the easiest, and it's are there any really small debts that we can kind of go after and just eliminate easily within our budget just to get rid of that minimum monthly payment on there to open up some of that buying power. We can do the same thing with maybe consolidating debt. Maybe you have a line of credit or a line on a credit card that's large enough to where you can put some other debts into it, and that minimizes what the minimum monthly payment is. Again, another way to kind of work or be creative in our debt to income structures to open that up. The last item is a unique piece under installment debts. There are certain loan programs that will allow an installment debt, like a car loan, that if you have less than 10 months on there, it's possible that we don't have to include that in the debt to income ratio. It's not a guarantee that that happens. In most cases, we can make that happen. Now, you can't buy down the debt to get it down within 10 months or less, but say you're close. Say you've got 12 months left on there and you've got 60 days as you're kind of going through this process, then we might advise you, hey, look, we'll just get 2 more payments down. We'll go back and we'll relook at the credit once that's updated. And once we can show that's 10 months or less, then we can remove that debt. I'll share a story with you on a unique scenario as well, where we had a client that had been saving up some money. They had talked to another lender. They were only approved for about $400,000, and they had been saving some of their own funds. They had recently gotten married, had some gift funds that were coming in, and they had a 401k that they were going to tap into as well. So they had already kind of discussed that they were going to have about $40,000 to get into this purchase with, and that's where their comfort zone was and what they felt like they had to do just to get into the $400,000 purchase price. Now, they weren't really finding homes that were going to fit their needs for their family, their growing family that they wanted, and they really needed to be higher. So after a review, I looked at them, I said, I can show you how to increase your buying power by $110,000, but you're going to put less money down. So they kind of looked at me sideways and how is that possible? Well, what we were able to do is we took $20,000 or half of that money they had kind of earmarked for that purchase, and we're going to use that to pay off a car loan. They had $20,000 left on a car loan that had a $760 payment on it. By eliminating that car payment, that opened up their buying power by over $110,000. Now, the way we structure this is to have that all taken care of at closing. So we're not asking somebody to go and take their money and pay off a debt before they're approved or before they've closed on the house. We can structure this to all be taken care of at one time at closing by paying off that car. That opened up that buying power for them. The $20,000 that they had left still met the minimum down payment requirements, and they still had funds left over for their closing costs as well. So finding creative solutions is just a unique way to kind of start when we look at those debt to income ratios. The next area to really consider to help maximize your buying power in today's marketplace is your credit scores. You know, there are some really simple things that you can do to really make an impact to your credit scores. Paying down your credit card balances, possibly going and looking and see if you have any collections and paying those off or trying to eliminate those, or possibly even opening up another line, a trade line through maybe like a secure credit card can have a significant impact to increase those scores. Having a higher credit score is going to reduce the risk for an investor, which may allow you to have a higher debt structure overall. A credit score is a reflection to an investor on your willingness to repay a debt, and the higher that score is, then the more willingness they are to be a little bit more flexible in those parameters. FHA is a great example of this. So FHA has, for most investors, has a minimum credit score of a 580. Now, if you're just getting into that level of a 580 to 600 range, an investor is going to look at that as far as an ability to repay a debt, and they may be more restrictive. You got into the loan approval, but now your debt to income ratios are going to need to be smaller, or they may most likely going to require some type of reserve account left after closing. So just what a reserve account is, if, for example, if you had a $2,000 mortgage payment and they wanted you to have 3 months of reserves after closing, then you would need to have $6,000 left in an account after closing. Now, this money could not be used for down payment or closing costs. It's just a reserve account to show that you had 3 months of payments left. That helps offset that risk. By increasing that credit score, that's going to help open up the investor's willingness to be more flexible on your approvals. Okay, so this is going to lead us into the last area of what we would concentrate on to try to open up that buying power in today's marketplace. And it's going to come down to loan programs. Now, the traditional loan programs for first-time home buyers are conventional and FHA loans if you're not a veteran. If you're a veteran, you definitely want to go look at the VA loan options, which are going to be the most flexible and the best priced. And we've got a great video that you can go watch on that. Now, if you're not a veteran, typically you're going to look at conventional and FHA loan options. Now, conventional is a really great program, especially if you have a higher credit profile and you have some funds to put down. They were typically sought after as the mortgage insurance is removable on those, and they are just a little bit more palatable to sellers in the markets in just the last recent years. Now, FHA is becoming a bigger player now. They're becoming much more competitive in price. They're just as competitive on interest rate, if not more so, than conventional. They're more flexible on credit. They're more flexible on debt to income ratio, and they actually have reduced mortgage insurance over conventional loans at this time. They've made some changes to that to bring this program back into the fold. Now, one of the reasons why FHA is a little bit more open on these ideas does surround the mortgage insurance. Now, typically on an FHA loan, that mortgage insurance is not removable. The only way to remove that mortgage insurance is to close down that loan through the sale of the home or a refinance of that home. But FHA is a government insured loan, so they have a monthly mortgage insurance premium that you pay on a monthly payment in your monthly mortgage payment. But they also have an additional insurance premium that helps open up the risk for these investors, and it's called an upfront mortgage insurance premium. The acronym is UFMIP, and what that is that's a finance portion that is added onto your loan balance. It's not additional down payments or anything of that nature, but it's an additional premium that is added into your loan to help offset that risk. So when we think about trying to open up that buying power, keep that payment as low as possible, FHA is becoming a very popular first-time home buyer program to open up that buying power, give you more flexible options, and get you the best monthly payment. So it's something you want to make sure you sit down and consider. Being creative in today's marketplace is just crucial, and making sure that you understand what the process is from start to finish is really important. You want to know what kind of loan options are out there, what your monthly payments are that you need to expect, what your total out-of-pocket expenses could possibly be. We go over this in one of our other videos calling what is the mortgage pre-approval process, and making sure you go through these in detail, opening up those strategies and having the right perspective is just important when you're moving forward on this next step, exciting step of purchasing a home in today's market. Our goal is to really leave people better than we found them. And if you feel like the person maybe that you're working with isn't really covering a lot of these items or haven't really given you additional strategies or paths to follow to get you to that purchase price that you're looking for, we would love an opportunity to do a review for you as well.